Welcome to the Impeach 47 podcast. The last time the United States government saw its publicly held national debt equal 100% of the entire U.S. economy, the country was fully mobilized to defeat the Axis powers.
Right, in World War II.
Yeah, think about the sheer scale of that. The government was building fleets of bombers, they were rationing steel, reshaping the entire global order.
That was a total mobilization.
Exactly. Wait, it was massive. But today, we aren't mobilizing a global military effort. We're operating in relative peacetime. And yet, our reporting shows that we just crossed that exact same mathematical threshold again.
We did.
The debt is sitting squarely at 100% of our gross domestic product.
It genuinely reframes how you look at the modern economy, doesn't it? We're carrying the financial weight of a world war, but without the actual war. And when you dig into the mechanics of how we got here, it becomes incredibly clear that this wasn't some sort of historical accident, or even an unavoidable crisis. It's the mathematical result of very specific, deliberate policy choices over several decades.
Yeah. And we found this trajectory mapped out with brutal clarity on a recent Wall Street Journal chart. And the data there is heavily corroborated by the Congressional Budget Office, Fortune, and the Tax Policy Center.
The numbers are undeniable.
They really are. So, our mission for today's deep dive is to trace that economic milestone. We're going to break down the mathematical story of how we got here, inflection point by inflection point.
Because while the national debt is often discussed as this abstract cloud floating above Washington, the policy decisions that built it are actually intensely practical.
Yeah, they affect everyone.
They dictate the flow of capital in the real economy that you interact with every single day. I'm talking about everything from the wages you take home to the price of the goods you buy.
Right. So, to really understand how we reached this 100% debt to GDP ratio today, we can't just look at recent years. We have to rewind and establish a baseline.
Back to the beginning of the chart.
Right. We need to look at an era of American prosperity that gets referenced constantly in politics, but is, almost never understood in terms of its actual tax policy. I'm talking about the 1950s.
The quintessential post-war boom.
Yeah. Our reporting shows this is an era highly romanticized, particularly by the Mad-GA movement.
Sure.
When you hear speeches longing for the days of a dominant manufacturing base, a thriving single-income middle class, and this pervasive cultural sense that hard work actually paid off, they're pointing directly to the 1950s. The goal is to return to a time when prosperity felt incredibly stable.
And the Wall Street Journal chart specifically annotates that era as the baseline for our modern economic history. But what our reporting shows is the hidden detail completely stripped out of that nostalgic narrative.
The tax rates.
Right. During that era of widespread prosperity, the top marginal income tax rate was 91%.
Okay, let's unpack this. Because if you are listening to this right now, your immediate thought is probably, if the government was taking over 90% of the top dollar, wouldn't that completely crush business growth?
That's the logical assumption, yes.
How do you possibly build the most legendary middle class in history under those conditions?
What's fascinating here is the mechanics of corporate reinvestment. You have to look at what high tax rates actually force a business to do.
Right.
In the 1950s, the tax code acted as a massive behavioral incentive. And on top of that, stock buybacks, which is when a company buys its own shares on the open market to artificially boost the stock price, those were effectively illegal.
Wow.
Illegal.
Yeah, the Securities and Exchange Commission considered them a form of market manipulation.
So a company couldn't just take a blockbuster quarter of profits and use that cash to buy up its own stock, enriching the executives and shareholders. They literally couldn't do it. And because they couldn't just extract unlimited wealth for the shareholders, and because an executive taking a massive, multi-million-dollar bonus would just get hit with that 91% marginal tax rate.
The money had to go somewhere else.
Right. Had to go somewhere else to avoid the tax man. So what did corporations do? They used their profits as a tax shield.
By reinvesting the money back into the actual business.
Precisely. Because money spent on operating the business, expanding, paying workers, that wasn't taxed as corporate profit. Corporate tax rates sat above 50% back then.
Half the profit, basically.
Yeah. If you kept the money as profit, the government took half. But if you spent it on building a new factory, hiring 1,000 new workers, or funding aggressive research and development, you didn't pay taxes on that capital.
So the tax code effectively trapped the capital inside the foundation of the business. You couldn't siphon it out the top, so it just pooled at the bottom.
It forced the money to stay in the real economy. As a result, wages rose in lockstep with corporate productivity.
Which is amazing to think about now.
It is. And if we look back at the debt-to-GDP ratio, this system of high taxation and high reinvestment was incredibly effective at driving the national debt down. The publicly held debt fell from its World War II peak all the way down to below 25% of GDP by the early 1970s.
Which brings us to a massive structural pivot. Because if that system of high taxes and high reinvestment actively shrank the debt and built the middle class, what specific policy shift caused the debt-to-GDP ratio to reverse course? And start climbing toward the 100% we are at today.
Well, for that inflection point, we have to look at the philosophy that took over in 1981.
Yeah. We found that 1981 represents a total rewrite of American economic theory. Ronald Reagan took office and fully embraced supply-side economics.
The trickle-down theory.
Right. The underlying theory was that if you aggressively cut taxes on the wealthiest Americans and corporations, that unleashed wealth would trickle down. It was supposed to spur so much explosive economic growth that the new tax revenues would effectively pay for the cuts themselves.
And the legislative policy followed the theory. Reagan slashed the top marginal tax rate from 70% down to 50% in 1981, and then chopped it again down to 28% by 1986.
But the math didn't cooperate with the theory. George H.W. Bush, who actually ran against Reagan in the primary before becoming his vice president, famously called it voodoo economics.
Which is a pretty harsh critique from within his own party.
Yeah. And our reporting shows the data proved him entirely correct. The promised tidal wave of new tax revenue never materialized. The trickle-down effect largely stayed at the top.
The numbers from the 1980s are really stark when you look at the raw data. Under Reagan, the national debt nearly tripled in nominal terms.
It tripled.
Yeah, jumping from $738 billion to $2.1 trillion. And the deficit, measured as a share of GDP, peaked at 5.7% in 1983.
Wow. But the tax cuts are really only half the story here. We found a crucial regulatory turning point in 1982 that fundamentally altered how corporations handle their cash.
Yes, the SEC rule.
Right. Reagan's SEC quietly legalized stock buybacks through a rule called 10b-18.
And that is arguably the most critical piece of the modern economic puzzle. Earlier, we noted that in the 1950s, buying back shares was considered market manipulation.
Yeah, illegal.
Rule 10b-18 was a deliberate deregulatory choice. It aligned with the new philosophy that corporations should face zero constraints on how they deploy capital.
To help visualize what a radical shift this was, I like to just imagine a working farm. Like for decades, the rules required that any leftover profits at the end of the harvest had to be spent on buying better tractors, fixing the barns, paying the farmhands better wages.
Building equity in the farm itself.
Right. That's how you increase the actual physical value of the farm. But Rule 10b-18 comes along and basically tells the farm owners, you don't need to buy tractors anymore. You can just take the cash out of the farm's operating accounts and use it to buy out the other owners.
It changes the entire incentive structure of American capitalism.
Completely.
The goals shifted overnight, from building a stronger business to extracting cash for the shareholders. And the data shows the behavioral change was immediate. In 1980, before the rule change, U.S. corporations spent just $6.6 billion on stock buybacks.
Okay, $6.6 billion.
By the year 2000, that annual number had exploded to $200 billion.
That's just wild, because when you reduce the supply of available shares on the market, the price of the remaining shares automatically goes up. It's pure supply and demand, but it generates zero actual economic value.
None at all.
You didn't invent a better product, you didn't train a better workforce, you just engineered the math. And since modern CEOs are compensated largely in stock options, inflating the stock price directly inflates their personal wealth.
And the resulting inequality is perfectly documented in the historical data. In 1982, the average CEO earned 50 times the pay of an average production worker.
50 to 1.
Right. Today, driven largely by this financial extraction mechanism, that ratio exceeds 144 to 1.
So the Reagan era establishes a very clear formula on the Wall Street Journal chart. You cut taxes, you deregulate corporate cash flows, and you watch the national deficit surge. The capital stops flowing down into worker wages and starts flowing up into stock prices.
It's a very clear trend line.
But when you look at this 40-year timeline, it begs the question, did any subsequent administration look at the climbing debt and try to revert to the old math?
Well, our reporting shows only one significant interruption to this upward debt trajectory over the last 4 decades. And it happened in 1993 when Bill Clinton raised the top income tax rate from 28% to 39.6% for high earners.
Oh, man. The political backlash to that at the time was apocalyptic. Critics insisted that raising the top rate would destroy jobs, stifle corporate investment, and crash the economy.
But the actual economic reality was the exact opposite of those predictions. Instead of a collapse, the United States entered a massive boom.
Right.
The government ran 4 consecutive budget surpluses from 1998 to 2001. That is the only 4-year stretch of budget surpluses we've seen between 1970 and today.
The only one.
The only one. And they didn't just balance the budget. They actively paid down $453 billion in publicly held debt.
Here's where it gets really interesting. If raising taxes mathematically resulted in a booming economy, actual budget surpluses, and debt reduction, why on earth didn't subsequent administrations stick to that playbook?
Because the philosophy of tax cuts as the ultimate economic cure was already too deeply embedded in the political system.
Right.
By the time George W. Bush took office in 2001, the supply-side theory was the default setting in Washington. The surpluses were viewed not as a buffer to be saved, but as excess cash that needed to be returned to taxpayers. So taxes were cut again.
But this time, the tax cuts collided with massive new spending. You had the Bush administration launching 2 huge wars in the Middle East, and unlike World War II, where the government raised taxes and sold war bonds to pay for the mobilization, these wars were largely kept off the books and financed through pure borrowing.
Yeah, you combine 2 unfunded wars with a drop in tax revenues, and then you add continued financial deregulation that eventually triggers the 2008 housing crisis.
A perfect storm.
It really was. The government had to borrow staggering amounts of money just to bail out the financial system and stabilize the economy. If you look at the Wall Street Journal chart during the 2000s, the debt line begins to climb in near-perfect correlation with that sequence of decisions.
And that steady climb throughout the 2000s and 2010s completely wiped out the Clinton-era progress. It set the stage for the most recent and arguably the most dramatic spike in the debt-to-GDP ratio, which brings us to the policies of the Trump administration.
Right. In 2017, Donald Trump signed the Tax Cuts and Jobs Act.
Our reporting shows that this legislation took a sledgehammer to the corporate tax rate, slashing it from 35% all the way down to 21%.
The Congressional Budget Office ran the math on that legislation, and they estimated that the 2017 tax cuts would add $1.9 trillion to the projected national deficit over a 10-year window.
$1.9 trillion. And the public justification for this, echoing the exact rhetoric from the 1980s, was that corporations would take this massive windfall, build new factories, create jobs, and raise worker wages.
But history repeated itself because the underlying mechanics hadn't changed. Rule 10b-18 was still perfectly legal. Corporations didn't use the windfall for massive job creation.
No.
They took that massive tax break and funneled it straight into record-breaking stock buybacks.
They took the cash out of the farm?
Spot on. The capital didn't go into the foundation of the economy. It went into extracting shares from the market to enrich executives and major shareholders.
If we connect this to the bigger picture,
Yeah.
what is the real-world cost of all this to you, the listener? Because numbers like $1.9 trillion can start to feel like monopoly money. It doesn't sound real.
It becomes incredibly real when you look at the interest. The public is picking up the tab for those corporate tax cuts. When the government slashes its revenue but continues to operate, it has to borrow the difference by issuing Treasury bonds. And that debt carries interest.
And thanks to higher interest rates in recent years, those payments are no longer just a minor line item in the federal budget.
No, they are eclipsing major foundational programs.
Yeah.
Interest payments on the national debt now exceed $1 trillion annually.
Let's just pause on that. $1 trillion a year collected from taxpayers just to service the interest on the debt.
That is money fundamentally diverted away from the real economy. $1 trillion sent to bondholders cannot be spent on repairing bridges, funding healthcare, expanding Medicare, or improving public education.
Right.
The wealth that used to flow into the middle class through robust public services and infrastructure investment is now being drained simply to service the debt created by decades of corporate tax cuts.
And the projections for where this compounding math takes us are chilling. We found that the Congressional Budget Office projects our national debt will rise from the 100% of GDP where it sits today to 120% of GDP by 2036.
And we should clarify that 120% is merely the baseline projection. That assumes no new major crises or spending packages.
Yeah, it gets significantly worse depending on what happens next. If the expiring tax cuts from the Trump administration's 2017 law are extended without any corresponding spending cuts or new taxes to pay for them, the CBO projects that the debt will reach a staggering 214% of GDP by the year 2054.
214%. I mean, try to conceptualize an economy where the national debt is more than double the entire economic output of the nation for a whole year.
It's hard to even picture.
At that level of debt burden, the government loses almost all of its flexibility to respond to an actual crisis, whether that's a pandemic, a severe recession, or an actual military conflict.
So what does this all mean? When we step back and look at this Wall Street Journal chart, the narrative isn't complicated. It is a visual record of 40 years of tax cuts that were aggressively sold to the public as economic growth engines, but were actually delivered as pure debt.
Yeah.
Our reporting shows that the most vocal deficit hawks, the politicians who consistently protested government spending under Democratic presidents, turned around and voted for the very tax cuts that drained the real economy.
The math was never hidden. The mechanism of how buybacks extract value and how tax cuts explode the deficit has been transparent for decades. The chart has always been there, tracing the predictable consequences of these specific policy choices.
Modern political movements love to point to the widespread prosperity of the 1950s as the ultimate goal for the American working class. But the data shows they are systematically dismantling the exact tax structures and corporate regulations that forced capital into the working class and produced that prosperity in the first place. The Wall Street Journal's numbers simply confirm the reality of that mathematical shift.
It leaves us with a very profound question to consider. We've seen that the prosperity of the 1950s was built on a foundation of high taxes that actively forced corporate reinvestment back into the working economy. If a society decides to fundamentally change its laws to allow corporations to extract wealth rather than build it, and then finances that massive extraction through endless compounding public debt, at what point does the underlying economy simply run out of real value to extract?
Wow, that is the trillion-dollar question we are all going to have to live through as these projections become our reality. Thank you for joining us for this deep dive into the math and the policy behind the national debt.
Thanks for having me.
If this reporting is useful, the way you support us is simple. We're the movement. Every hat, shirt, and sticker from impeach47.earth is a walking billboard and the thing that keeps this research fed.
Understanding the actual mechanics of our economy, rather than just the political rhetoric, is how we hold the system accountable.
You can read more of our detailed reporting on Substack. And be sure to follow us on X at impeach_47, on Instagram at impeach.47, on Threads at impeach.47, and subscribe to our YouTube channel at impeach_47. We'll see you on the next deep dive.